All right, hopefully everybody had the link worked and everybody's in. I'd like to welcome everybody to our annual real estate review and forecast. I'm Tom McLaughlin. I'm the president of Colliers for Saskatchewan. Just 1 year ago, on a much colder day, we're all gathered together as a real estate community, sharing knowledge, connecting with colleagues and friends, and meeting new people to discuss the important issues of the day as they relate or might impact our industry. It's amazing how quickly things change, and while we're pleased that we're able to share knowledge today, we definitely miss the opportunity to get together. It is, of course, the people in our business that make it the most interesting, engaging, and fun. This year, we've had to pivot our presentation format to online and consider what would be of most value to our clients in the industry at this time. Given the changes and uncertainty, we thought a deeper national perspective would provide some insight into where our future might be headed to help you navigate forward before getting into the nitty-gritty of market specifics. We're pleased to have Scott Addison, our Canadian President of Brokerage Services, join us today to give us those insights and trends in real time. Scott has been with Colliers for over 30 years, starting as an industrial agent in Toronto region and progressing through increasing leadership responsibilities to lead our over 450 agents across Canada and the talented team that supports them. Anecdotally, Scott was one, if not the first person I met when I joined Colliers 25 years ago. In addition to Scott, Richard Jankowski, our Managing Director of Brokerage Services, who leads our team of over 50 professionals in Saskatchewan, will provide an overview of specific market fundamentals, future expectations, and insight. Our plan is to complete within the hour. There's an opportunity to ask questions, so please put them in the chat box, and time permitting, we'll respond to as many as we can. There's just a couple of slides I'd like to share before I turn it over to Scott. I would be remiss not to talk about our great team. We have over 150 Saskatchewan-based team members amongst all disciplines, including 46 agents and debt advisors, supported by our great marketing, research, and administrative professionals. We're very proud to exceed 10 million square feet under management for the first time in our history. Many years ago, we set that as a goal, a BHAG as it is called, and have been privileged to grow with our clients and help them through the ever-increasing complexities of property, facility, and asset management. This year, those complexities were accelerated to a whole new level, and we're thankful for the dedication and focus our team had through a challenging time. One comment on our REMS platform. We made a decision a couple of years ago to press forward with significant technology investments and now run fully on the cloud with the most sophisticated platform. I made a joke to our team at a recent town hall that we're now a technology company, as it's one of our largest expense items. Our platform is robust, and there's much more we can implement from it, and we're all excited for what the future will bring. We want to be able to support our clients through their real estate needs with the best expertise, and we continue to build on our platform through 2020 to achieve that goal. Our team in Saskatchewan delivers transactional brokerage, property management. We have the largest team of project managers, a group that works solely for owners and tenants and are independent. One of the most exciting additions, which started in late 2019, was our debt advisory services in Saskatchewan. As we all know, the capital structure behind real estate is critical to its success. Saskatchewan has not had the benefit, as most markets do, of sophisticated debt analysts and placement. Our team has deep experience and credibility in this area. We've also had success bringing our national experts around workplace advisory, development management, corporate solutions, and strategy and consulting to ensure our clients are getting all the support, information, and advice to get to the best possible outcome for them. All of these services are not required in every situation, but they're available when needed. One last slide is our commitment to our community. Community is very important to us at Colliers, our internal community and the communities in which we live. While 2020 required a lot of focus on our internal community, we did our best to raise much needed funds to fight food insecurity and for families in need and have a little fun doing it. COVID fun, if there's such a thing. We hope that in 2022 will allow us to return to our Colliers Cup Street Hockey Tournament. We've raised over $120,000 for the Jim Pattison Children's Hospital and are now committed to helping Haven Kids House help families in need. And with that, I'll pass it over to you, Scott, to lead us through a national perspective. Welcome to Saskatchewan.
Thank you, Tom. I always enjoy coming to Saskatchewan. I've been there a number of times now. and actually seen some of your lakes. It's been fantastic. Really appreciate the warm welcome, and it makes me feel great to see what the Colliers has done for the community. And we're so strong in the prairies. It's one of our it's one of our differentiators when we're talking nationally to our national clients, is we actually cover the prairies with lots of good quality people. So thank you for having me on this call. I'm going to give you some high level discussion of what's happening in trends across Canada, work from home, etc. You're going to hear lots about that. And then we'll ask questions. And if you want to get more granular and have a conversation with me, we'll share my contact information. You can reach out, and I'm more than happy to share or get a real expert on to talk to you. We have lots of office practitioners and investment people that can help you. So we'll leave it at that. But thank you for having me. Hopefully this is interactive and enjoyable. So trends across Canada. Really, lots of discussions. I don't even know whether to call this a recession that we're in right now. It's definitely a disruption of the economy. And in the 33 years I've been in commercial real estate, I've seen 4 disruptions. 3 of them I definitely call recessions. This one's really strange because it's very unequal. The travel industry, hotel and hospitality industries absolutely getting decimated, home fashion getting decimated in this, yet the property market's doing really well. Certain other sectors, technology is doing well. Home products are extremely strong. So it's a very different economic, we use the word rebound here, but some groups have gone through without any effect at all, and then others have had huge effects. Another big trend is in our largest urban centers in Canada, we'd seen a trend from the suburbs to downtown. And you heard like great Canadian names like Tim Hortons moving their suburban office group downtown Toronto so they could hire staff. And, it was all about recruitment. You had to be downtown. So that during this pandemic has absolutely reversed, and we're seeing an upsurge in interest in suburban office, which is a complete change. So the headline in 2019, if I was doing this, is downtown versus suburban office and people moving down. It's actually completely reversed right now. We'll get into that a bit. Industrial, no end in sight. That market's extremely strong. If you drive through the industrial parks across Canada, people are working, they have to work. We need commodities. The stores are still busy, people are buying. So industrial is doing extremely well in general. We'll get a little more granular on that. Retail, retail's still there. It's being repurposed. There's some definite bright spots in retail, and we'll talk about that. And then there's this called Mind the Gap. If you read the papers or the internet, you would think that the office market landlords are absolutely in disarray. They've got huge vacancies. They're not collecting rent, and there should be some real distress situations in office. Well, if you're an expert in the industry and you're working there, you know that that's not the case. Vacancy rates are still relatively low. Yes, there's some sublets coming on. Rents largely have held strongly across Canada, and there's very little, the ownership of office across Canada is now so largely institutional with deep pockets. This downturn's not affecting them. Will it have a long-term effect? Possibly, but we're not seeing a huge amount of distressed properties and low rent deals being done in the market. Next slide, Tom. It's not all about COVID either. Everybody seems to, we're all focused on it because it's affecting every one of our lives and it's in front, but there's still trade wars going on. And maybe the word war is too strong a word, but with China and the US, we have a lot of trade difficulties with 2 of our largest trading partners that we're working through. And that is affecting the Canadian economy in general, whether it's agriculture, commodities, or manufactured goods. Commodities, oil, stay with the last screen just for a second, Tom. The oil sector is obviously been decimated and hurt, and that drives the Canadian economy. The bottom graph of Europe, there is, one of our largest trading partners is Europe, and with BRICS going on, there's effects there. And the Biden-Harris election is probably not going to be pro-Canada. We've already seen the XL pipeline stopped. So there's more headwinds in Canada than we think of just COVID, which everybody in the world is working with. Now we can move on. I find this an interesting slide. It's really showing that the rent collection is really rebounded. After initially in COVID, retail was really hard hit, and office was relatively hard hit with a drop in rent collected every month, and that has largely rebounded. It doesn't mean everybody's current. So they're collecting rent on a monthly basis, and there can be some debate about, is it full rent or is it rent that's been negotiated a little lower? But it's pretty healthy, the amount of clients paying rent, the amount of tenants paying rent in the market. Next slide. Investment volumes, no secret here. Investment volumes were dramatically down in 2020. All across the major cities in Canada. What we are seeing, the biggest trends we're seeing is multifamily is an institutional favorite right now. We're seeing privates sell multifamily properties and institutions buying it. Nice secure income, people need a place to live. Immigration will be back in Canada, driving strong population growth in the future again. And industrial, number 2 favorite when I talk to institutions across Canada. Retail, third. Office is where all the uncertainty is right now. So completely different maybe than it was 5 years ago, when office and retail were, regional retail and office were the dominant factors. So we've seen that shift happening. This graph really shows you the difference between 10-year mortgage rates, the bond rate, and cap rates across Canada. And it shows you the gap. The 435 was the risk spread in the global financial meltdown in 2009. Once Goldman Sachs and Lehman Brothers, et cetera, had gone through their real shakeup, and everybody was worried about the worldwide financial economy. Cap rates have continued to come down, but the risk spread did grow at the beginning of COVID. I would say we're looking at these numbers now, we couldn't publish them because we're uncertain of them, but again, that's closing the risk. People seem to be adapting to the risk of work from home and how that's going to affect office and what's happening with retail, and we're starting to see people compress again. So that's good news. People are accepting the risk and still think it's commercial real estate's a strong investment in general. Next slide. So let's dive into office a little bit more. There's lots of trends going on, and this slide will give us some of those. Work from home is definitely a factor. That's going to be a long-term, and we'd be putting our heads in the sand to think that companies are not going to give their employees more flexibility and more ability to work from home in the future. But a trend that had started pre-COVID was detensification. Some of these large office users, where they push people down to 120 feet per employee, they'd already started expanding. A few of the multinationals. Why? There was health problems, there's stress problems, there's absentee problems. So that trend is going to continue, and especially COVID's going to accelerate. You're going to see more square foot per person. You're going to see a phased in. I think this slide now might be old news. Phased in return to the office. It's going to happen over the next 3 months in some areas in Canada, 18 months in other areas of Canada. I think the downtown Toronto is going to be really slow, in Montreal getting back to the office. And we're already hearing people talk about dates of next 2022 to be back in their office in the downtown core. Technology, it's a huge growing sector in Canada, so it's driving demand and it's continuing to grow. Calgary just secured a couple big tech companies to move into some vacant office space there, but it's also a driver allowing people to work from home. We can get into that a little bit better. People are really starting to ask, what's the wellness of their office? What's the air quality like? Questions we never really had to handle in the past, but that seems to be a big factor. Collaboration, no doubt, people are missing that. And so everybody who's looking at new office space or expanding, what are we going to do for that? And we've really got to rethink our retail and amenities at the bottom of offices and make sure that they survive. That's one of the reasons people like to come to the office and work, is because there's amenities and retail below, and that sector's been hard hit. Tom? So where is office occupancy? This graph just shows you it's bumping around, 20% of the people that could be in offices are in office. 80% of people in North America are working from home. So this is a North American number supplied. What we're seeing in Toronto and Vancouver, the two largest urban cities, suburban offices might have a 30% occupancy rate, and downtown offices 8 to 10% in general. But we are seeing more and more people creep back into the office. This graph, there's been a long-term trend. So it's not 100 square feet, but if 2000, first quarter of 2000 was the basis point for looking at how much square foot per employee we're giving, we've seen a steady decline in that till last year. We would have predicted that was starting to bounce back. On my earlier comments, we're starting to see larger corporations give people more space, but we think work from home is going to continue that trend. So there'll be less square feet per employee as we move forward. Some of those employees will be working remotely or hoteling. Things are changing rapidly. The screen on your left is just showing you at the beginning of COVID, nobody said they needed more office space. More people thought they would shrink their office space and keep the same amount of space. And that's in a 8-month period. That's dramatic. It's probably 6 months different. That's dramatic. We're starting to see changes, and we are starting to see 4% of people starting to say we need more office space. So what initially we saw at the beginning of COVID is not holding true. The other thing that's driving this, everybody was making do and it's good enough. And maybe some of you are experiencing this now. Digital friction. That's when your Zoom call starts, not working and people are freezing and your computer freezes because you're wireless at home. People are getting frustrated at that. That's going to drive people back to the office. That's what the graph is really showing you. There's a high percentage of people that are frustrated with the technology in their home. They're making do. So office, we see some trends that are going to give some increase in office space, more collaborative room, health and wellness is going to drive that. The hub and spoke model. I think what's interesting on the hub and spoke model is downtown office, suburban has typically been in some of the larger cities. We are actually seeing downtown office and maybe backrooms move to lower rent areas, and Calgary right now has been a beneficiary of that. We've seen that happen a couple of times. Space decrease, work from home. We think that you're going to see a lot of companies allow employees to work a day up to 4 days from home. We're also seeing COVID has really pushed technology, the paperless environment. You need less space for that. So there's a number of things pushing less space, less office space out there. And there's a lot of things that are keeping it neutral. Yes, we have work from home and flexible work relationships, but we're putting in more collaborative space. That's what we're seeing in the space plans that are being done now. So lots of change in office, but office is not dead. Office fundamentals. The two real trouble spots in Canada, and it's been long-term, are Edmonton and Calgary, where they've got Calgary downtown, 25% vacant space in their downtown core. We are starting to see some absorption of that. As I said, some backrooms are looking at it. Rent's been going down, but largely across Canada, like if you look at the Toronto numbers and Vancouver numbers, during COVID, rent net asking rates have actually gone up. If we went into a downturn in the office market, we couldn't have gone into it in a stronger point. Vacancy rates were extremely low, historic lows, 1%. 8% would be considered a healthy, balanced market in these cities. 1% rental rates are as high as possible. You couldn't find, like, just a year ago, agents in some of the major cities in Canada were complaining that they were having multiple offers on space and they couldn't find good space for their clients. So we went into this in a really strong position. I think that's what's keeping moderating the market. And Calgary and Edmonton, that's really a commodity problem. The graph on your right was just showing vacancies in suburban space have historically been lower in the downtown market. Suburbs always had higher vacancies. That actually crossed last year. The vacancy in the suburban market dropped, and we don't see that correcting until about 2024, because we do think there's going to be more demand for the suburbs because of transit. People don't want to take transit, and that's going to take a while to work through. Tom, next slide. So office technologies driving changes, both good and bad. Workplace strategy is becoming important, more collaborative space, larger space per person. The fundamentals, a lot of sublets coming on the market, but we're not seeing a lot of deals hearing, and there's some talk that some sublets are being pulled off the market as companies rethink their space and think they may be overreacted. And there's always that flight to quality in a downturn in the market. We're seeing that flight to quality, and old buildings talking a lot about retrofitting air handling equipment and security measures and public wellness factors. Jumping into industrial, my background. So Vancouver, Toronto, locked by water, locked by in Toronto, a Greenbelt, Vancouver Mountains. So this first corner, buy land, they're not making anymore. I realize maybe in the prairies, that's not quite as much of a factor, but in most cities, it's more of a, forget the geographic boundaries. It's really how fast can you bring land on? And with government regulation and just the time it takes to develop a property, there's a lack of serviced available land out there. Industrial, we're seeing increased rental rates, increased trucking rates, increased labor rates across Canada, and there's real inflation in the industrial segment of the market, and costs are going up, which means they're moving to more technology, higher clear height buildings. We are seeing buildings like the picture of the building in Vancouver. It's going to be a 2-story office building, that industrial building that Oxford's building, and we're hearing about more. There's a 5-story building for Amazon in Ottawa for their last mile distribution, but that multi-story probably won't be the trend, but it's being driven because of these rising costs of transportation and land and labor. The Amazon and e-commerce, huge effect in industrial. Amazon across the country took about 11 million square feet of new warehousing space. And but it's not just Amazon. The grocery stores have got e-commerce, Canadian Tire, Walmart. We've been working on new facilities for all those clients, and e-commerce is expanding. But it's not, everybody has the Amazon effect. It's not just Amazon, it's the message here. Next slide, Tom. This is kind of remarkable. You're really looking at the price. The green line here is the cost of couriers and deliveries and local deliveries across major markets in North America. You can see that's dramatically rising because of e-commerce. How many deliveries have you got today to your door? The next graph just shows the rising costs of labor in the province of Ontario. So it's well outpacing inflation. It's more than double inflation. So that's driving bigger warehouses, more automation, and higher clear heights on buildings. Next slide. Industrial fundamentals, largely the same story. Industrial's on fire. It's one of the real strengths of Colliers. And We're seeing dramatically increased rental rates across all markets except for Alberta. Alberta's struggling with so many of their industrial or sheds, as they call them, machine tool shops, etc., which are obviously slow. Rental rates are up in almost every market. Vacancy rates are at historic lows. So really quite a strong industrial market, and we don't see an end in sight to that right now. So very positive story there. This slide, I'm gonna have to put my glasses on to get my colors right on this slide, but I think on the right-hand side, industrial asking rates, the big story there is Toronto in red. Historically, Toronto had a kind of a nonsensical asking rates on industrial net rents of under $6 a foot, some of the lowest in Canada. And you would see other markets are up or $9 or $10. Well, Toronto's risen faster than everybody, and we're hearing rents $10 to $13 a foot for 200,000 square foot facilities, like big boxes and up. So that's a huge change in Toronto, and what we're worried about is, will people look to other areas for distribution south of the border and try to move in? This graph's just basically showing you the trend of asking rates and vacancy rates. So same graph, they're positively going up. But if you look at it across Canada, it's not a hockey stick, which it tended to be in Toronto, dramatically increased rents. And we are predicting vacancy rates going to continue to drop. We're not building buildings fast enough for the industrial growth across Canada. Next slide. So that was pretty high level stuff on Canada. E-commerce and automation is certainly driving. If you've been through some of the distribution or FedEx's new facilities, you're just seeing a high level of automation. And I was in a major retailer's facility, 1 million square feet. Big part of that was close to 100-foot clear. All the product was being handled by about 8 tech guys sitting in it. Looked like an airport control tower, and they were running all the automation to move the product to the trucks. It was just absolutely fascinating to see. So a lot of people look at the Canadian manufacturing and employment by how many people are working in the industrial sector. I think you're starting to see a real shift away from people actually moving boxes and putting parts on cars, et cetera, to automation doing that. I talked briefly about two-story or multi-story industrial coming back. I don't see that as a huge trend, but we are seeing a trend. You know, if you think back into the 80s, you know, 18 to 24 foot clear, 24 foot clear was a tall building. Then it went in the 90s to 30, 36 in the 2000s. We're seeing most spec buildings in major cities being built at 40. And because of new advances in material handling and racking, we're starting to see some 80 to 100 foot tall buildings being built, not on spec, but being built for demand for those large e-commerce retailers. Land, we're seeing prices in some of the major markets hit astronomical numbers, like 40, 50, 60, 100% higher than 2 years ago. So dramatic increases. A large site, 30-acre site in Toronto suburbs sold for $3.5 million an acre. I thought $2.5 million sale 2 years before one of our big funds had bought was crazy. Very similar sites. So huge increase in that. And I talked about the rising costs in industrial. Next slide. Retail. So retail, again, it's not dead. Here's a retail sales outlook in Canada. And obviously, as we went into the pandemic, retail sales fell off the cliff. Everybody was uncertain, how bad is this going to get? Then the government stepped in and really righted the economy, and I think did the right things by injecting cash in. And consumer confidence is very quickly started rebounding back. And we think it's going to be back at the same level. This retail spending will be at the same level by the end of this year as it was prior to going into the recession. Consumer confidence There's now a second group, Bloomberg, tracking consumer confidence, and we're seeing different stories. Consumer confidence has definitely rebounded, but if you look at the red line, it shows that consumer confidence has rebounded, but only to where it was at the depth of the global financial meltdown, if you believe IPSO. If you look at Bloomberg's new numbers, and they've started tracking because they think consumer confidence is higher. There's lots of spending in the market. They're much more confident that we've rebounded to a more normalized number, which anecdotally I tend to agree with. It's really unequal, and not all retail is hurting right now. I talked about obviously hospitality and travel and tourism, obviously for obvious reasons, clothing and etc. I'm not wearing a tie today. People aren't spending money on suits and dress wear to go out to parties and restaurants. So clothing and accessories is down, definitely down. Nobody's driving their cars in major urban areas to the extent they were. So gas stations and automotive are down, and sport and hobby, et cetera, they're down because a lot of the facilities are closed, but also they're having significant supply chain problems. So their sales are down for different reasons. I think Peloton is probably a good example of that. If you went to order a Peloton, apparently they're 10 to 12 week delivery on that. But look at home and garden and home spending dramatically up. E-commerce, it's still a relatively small, you can go to the next screen, a relatively small portion of our economy. Typically going into pre-COVID, 3 to 4% of people were products were being ordered online. Every time there's a lockdown, that spikes, and then it drops down as stores reopen again, to be expected. But the trend I want you to notice is people, as we have people use e-commerce and spike and get accustomed to it, they stick with it. And many people have had that experience. So we think e-commerce is going to continue growing. So when people talk about retail sales, how's it going to affect the brick and mortar? Well, our prediction is the brick and mortar is you're going to see increased vacancy in brick and mortar as people order online. We think that the Canadian online sales in the US, it's running somewhere around 12 to 16%. We think Canada is going to move up close over a longer period of time. We seem to be a little slow to adapt, but it is convenient that we'll adapt. So retail, there's a lot of pain out there in retail. There's no gain. There's a lot of retail being repurposed and looked at and being turned into things like schools, universities, mixed use facilities, or torn down in some cases and redeveloped. E-commerce, huge impact. I think it'll be 15% of the market. When you can order something from Home Depot and it's delivered to your house the next day or that afternoon, and it's cheaper than driving to Home Depot and it's convenient, it may make you go to Home Depot less on Saturday. A lot of retailers are looking, how can they get people back in their facilities? They've really got to make it, people feel safe, feel clean, and you're seeing all sorts of air handling, sanitary, what's being done, advertising how often they're cleaning their malls, etc. So that's a big trend, because there is real and realistic fear that, hey, it's not safe to go into a big enclosed mall. And we're seeing all sorts of new technology once you get into the mall, showing you where things are on sale and how you can go to, what's the quickest path to get to the store you want, but what stores might you want to stop in. So retail's, it's not dead, it's dramatically changing. That's, I guess, good for brokerage and good for those who can do value add. So unequal and fragile economic rebound. Downtown versus suburban. The suburban is actually showing real strength in office, industrial, good. Retail repurposing, opportunity there for the right people, the entrepreneurial people out there, but it's going to be a little bit rough. And there's a difference between what the public sees and reads in the paper and reality on the street when you're trying to renew a lease in office space. But in general, we couldn't have gone into this at a stronger point in the commercial real estate market than we went into. It's lasted a lot longer than everybody expected. And we'll see, it's going to be an interesting 12 months moving ahead. So I would like to give some acknowledgement to our research departments. We hired a new national research director, Rolly Van Dyke from CoStar, and used to be one of our competitors. He's taken our research to a new level. He put a lot of this information together, and our local teams have also helped. So Rosemary, Wendy, and Brendan in the province of Saskatchewan helped put all this information together. Colliers has good research. If you need information, please reach out to us. We're more than happy to share with you. So I'll turn it back to you, Tom.
Thank you very much, Scott. Appreciate that, and lots of interesting information. And it's interesting. It's always interesting to see things on the national perspective and how they then end up in Saskatchewan. So, on that note, Richard, over to you.
Thank you, Tom. Thanks, Scott. Yes, I'm just going to say in normal times we like to watch what's going on in the larger centers because they're usually the first to go through the trends that we can adjust to. And of course, we know these aren't normal times. But my goal for the next while is just to compare the trends that you talked about, some of the takeaways from your presentation, then look at our data slides for the market and offer some takeaways for Regina. You mentioned the team and data. We track over 80 million square feet of space, so it's a big job to keep up with. But our goal remains to be number one in this area, and our success is obviously driven by the team. Yeah, so welcome Rose and Wendy, our new market analysts, and Brendan, provincial data associate. These folks have backgrounds in finance and accounting, computer science, and Wendy's background in lean and project management is going to be a real asset for us. Brendan's background is in data analytics and research. The sales team, our debt advisory team, we've got over 450 years of expertise in Saskatchewan. This is Regina. Regina's team, we will add in the debt advisory as well. It's the largest team that, as Tom mentioned, in Canada and one of the new service lines. So we're out there in a strong way out in the market. So in terms of the highlights or headlines for Regina in 2020, yeah, the COVID blanket was out there. It's the eye of the storm, so to speak. We keep saying this is a health crisis and not an economic crisis, but the reality is the challenges are out there. Air travel, hotels and restaurants have faced this head on. Of course, on the upside, we've discovered the staycation, had the chance to do this myself in the winter, and we aren't immune to the fragile economic expansion that Scott talked about. But I want to say with confidence that we're in a position to rebound as quicker than any jurisdiction in Canada, mainly based on or driven by our diversified economy and our growth in trade outside of North America. There's some telling story here with looking at the impact of COVID on building permits. You'll notice a decline in commercial permits, the lighter color, in the past couple of years. There's been a drop from 164 million to 105. That's about a 36% decline. Meanwhile, the upside is a $50 million rise in residential permits. So that's good news. The supply chain challenges are going to continue to impact the construction industry. And of course, public sector debt will increase. That could affect support programs that drive construction costs. We really don't know the exact impact at this time. But government stimulus programs for infrastructure will be a story for next year and likely years to come. So getting into the specific asset classes, I'll start with the office market and just take a look at downtown first, new supply absorption and vacancy. The net asking rates have remained steady despite a just under a 2% lift in vacancy to 14.5% of the downtown, and that's where the bulk of our inventory is. That's close to Saskatoon's downtown vacancy of 17.7. Regina's downtown office market already went through a transition of low vacancy, but that changed when new inventory came to the market a few years ago. Most of the absorption in our cities in Saskatchewan is lateral movement by existing tenants within the market. So it's logical to expect vacancy to rise in parallel to the new product. Overall, we're seeing a trend by tenants to downsize their overall office footprint, especially in finance and government. The new supply that's shown there is a Connexus building on College Avenue. So as Scott mentioned, we'll see what the future brings with what does a post-COVID world look like. In the suburban market, somewhat of a similar story, although smaller inventory footprint. It's isolated to a few nodes in the city, the largest being the Research Park at Innovation Place, where vacancy has increased in the last while from 11 to 12.8%. Of course, the City of Regina bylaws will come into play here, which restricts future development outside of downtown until vacancy reaches a certain threshold of what's considered healthy in the market. There was, Scott, you mentioned a flight to quality, and we're seeing that here. There's definitely these are challenging times for Class B properties where lateral movement, as I mentioned, into new spaces siphoned tenants out of that submarket. We expect to see landlords get more aggressive with inducements to attract or retain tenants. Meanwhile, we're also seeing tenants pursue short-term leases or postpone their real estate decisions just because of uncertainty of where things are going. One thing that'll take, we know this fairly strongly, one thing that'll take a couple of years to work its way through the system is the fallout of working from home, which tenants will have to address on renewal. So that keeps this asset class at a state of flux for some time, especially in downtown, as I mentioned, where 80% of our inventory lies. In terms of net asking rates, if you look at year over year, there hasn't been a lot of change in net asking rates other than the Class A downtown space. So the face rates look stable. In other words, net asking on the surface, but net effectives have dropped, and they've dropped into the single digits in some properties where inducements were needed to close a deal. Again, we're in a wait and see state as tenants move through working from home and deciding what their footprint will look like post-pandemic. A few notable trades and transactions to talk about. This is a confidence statement, the Bank of Montreal, where long-term renewal was transacted. It shows some confidence in staying in the downtown. 395 Park Street, an office complex sale that traded at just under 6.2 cap. Property on 13th Ave that sold to a company for $3 million, and last one of a longer, more complex lease transaction, 124,000 square foot long-term lease and redevelopment of space. So some movement in different areas. Want to offer some words of wisdom today, and to landlords, tenants, and investors. In terms of landlords, definitely taking a longer view on this. We will come out of it, but having a trusted and informed team on your side is key. Focusing on creativity, definitely retention, and being prepared to invest or reinvest where that movement of tenants is occurring. On the tenant side, there's options out there, right? So seeking out and understanding your options, considering a plan that addresses your team's retention and return to office. What does that all look like? And from an investment standpoint, the market's going through an evolution here. So understanding that evolution, leaving no stone unturned. And, I'd say, especially with Regina, the understanding public policy, this could be on the federal government side, is just understanding public policy and the implications on your assets. So we move into the industrial asset class, and again, take a look at supply absorption and vacancy here. We have, we're no different than the rest of Canada. We've got a very strong industrial market, and I was putting this stuff together. It's like I got pretty pumped seeing the numbers. If you take a look at that, we're at a 4% vacancy rate right now, which is particularly due to a couple things. One of them being a limited amount of new inventory that's come to the market. Most of the absorption in 2020 was a result of larger deals at TransLink Logistics Park out at the Global Transportation Hub. Scott's national data slides, though, as I said, are reason to be optimistic. The Toronto net rates are on par with ours for the first time. And in terms of Saskatchewan or locally, we've got a very favorable business tax structure. Labor supply is stable to good, and service land is plentiful. Not all markets can say that. So our challenges will likely be lumped into three groups: supply chain issues or challenges that result in material shortage or construction cost increases. Secondly, for us, competing with Winnipeg for prairie region business. And third, the one thing that gets forgotten about, and that's energy sector setbacks. Moving into the net asking rates, down last year to just under, we're just under $10, $9.98, I believe. With the limited supply, the demand, low vacancy rate should lift these rates up. So we're showing a lift in rates for 21 and 22. Moving into the industrial subdivisions, we have some of the best distributed land parcels of any market of our size in Canada. 7 subdivisions in the region, and right now there's well over 900 acres available for buyers and developers. The bypass highway network is complete, and so that means we're in a logistics and supply advantage overall, and basically set to grow for decades of future growth. Just remember that chart when we move into the retail in a minute. Just on land sales, though, obviously we've had a slowdown, so we're coming into, this is a pre-pandemic thing. The land sales have been in decline for several years, peak years being 2011 and 14. Those are large transactions at the GTH. So they're going to be hard to match. But if you take a look at those regional parks outside of downtown, and given the average price of just $200 an acre, we are in a good position to accelerate. The COVID's been the story for the past year. As I said, let's not forget about pre-COVID challenges such as energy sector woes and so on. But the pending vaccine, the need for our resources, a strong business and development community, those all bode well for Regina and region. In terms of notable transactions, again, a few to talk about on the lease and sale side. 435 Maxwell. That was a tenant taking the building as is, investing their own money into it, turning it over in exchange for a reduced rate. Just some creative work between the landlord and tenant. 565, 555 Park Street sales. Owner users, local companies needing to expand. Nice to see that good news story on a local basis. And 614 Solomon was a lease to a recreational user, which considering a pandemic, those are good news stories. Words of wisdom on the industrial side. Landlords, look after your tenants, and there is a real need to understand the nature of the tenants' business and their economic challenges. Investing in property and or reinvesting is going to be key. Things like systems, lighting, environmental, etc. On the tenant side, understanding the supply chain impact of your business, staying on top of some of those government programs, it's really been a huge help through the past while. And if there are challenges, talk to your landlord and be real in sharing the information to build a bridge. It's a partnership as we work through things. Investors, watch for change as we go through this cycle. Cap rate compression will continue because of limited deals out there. So being ready to move is key. We feel that there's opportunities to build in that 10 to 20,000 foot range. So stay tuned for that and watch and reach out if we can help. On the retail market, supply, absorption, and vacancy. This story here, again, as Scott mentioned, no surprise, increased uncertainty, lift in vacancy rates, which jumped by just under a percentage point. We're at just over 6% in a market, in our market that's considered soft. It's really not that bad, but it's soft for what we're used to. We feel that should plateau and at some point, and possibly it's going to drop off in Q4 of 21. A lot of this is going to depend on the lingering effects of government programs and business. Projects like Aurora and Acre 21 in the east, Capital Crossing in the north are still in progress. The hardest hit sector or submarket in restaurant in our city, no surprise, restaurant sector with limited capacity and third-party delivery apps impacting their revenue. I want to speak to the recent and future developments, and I mentioned a few just earlier, but it wasn't long ago that we were talking about only a few developments, key ones, albeit, with Acre 21 and Capital Crossing, Grasslands. But we've got, you go back to the industrial map and then you look at the retail map, we now have several projects underway or in the planning stages. Check out the percentage complete on the right-hand column. So we're in a position of growth for decades to come, and that's good for the city. So rental rates, newer product. Tom, we want to just flick to the next slide there. Newer product is going to demand higher rental rates, just given the quality and the all-in cost of construction, including servicing and development costs. So the south and southwest sector, South Albert grasslands have an abundant mix of both product types, which is reflected in our asking rates. Meanwhile, the Southeast Power Center is holding its position on asking rates as well. So southeast, that's where the newest product is, or the bulk of it, and the rates are holding. Just want to talk about trends and noteworthy brands. Retail is always about trends and brands. Skip the Dishes, Uber Eats, DoorDash, these third-party apps have dominated the food delivery market, good or bad. They're definitely disruptors. There's been no shortage of hard news stories. Companies like David's Teas, La Senza, Aldo, they've hit on hard times. Like in our last national report, we had in excess of 24 well-known brands in Canada in a challenging spot. And then on the upside, there's companies like Sephora that are making news after announcing the largest store expansion in their history in the past 21 years. Cannabis, the cannabis boom. In 2020, in September 2020, our provincial regulator, which is Saskatchewan Government Liquor Authority, or SLGA, they removed the cap on the number of cannabis retail stores permitted to operate in the province. So we now have a system that allows cannabis companies to manage their distribution and supply. So these companies are pushing the envelope to change any stigma about their place in the retail economy. Want to see, we know that they pay premium rates for their space. They'll be part of the future for sure, as new science, new products, supply chain solutions, and social acceptance increases. And then there is the big solution. Great news in terms of the announcement of, and the world's call to action on vaccines. This is probably the bigger driver to fix what's going to happen in the retail market going forward. There's two more new ones that have just come out in the past week. So we'll get there in time. And the province, for people that aren't from Saskatchewan, the province is planning to make announcements on relaxing our restrictions. Hang tight, as the Premier said, fingers crossed for all of us. So transactions in retail, some of last year's notable transaction, we were initially saying it seemed like a slow year, but there was some interesting deals to speak about. 870 Albert, this is a 5-year deal with a company that came into our market out of Alberta. 4150 Albert Street, landmark shopping center in the South End, which sold at a 626 cap rate. 3151 Truesdale, the Dairy Queen, which sold at just under a 6% cap. That's a market indicator that investors are willing to place capital in quick service food assets. And then last, 2601 Avonhurst, a nice lease in the Northgate Medical Lab Center. So advice, sage advice or words of wisdom here. For landlords, again, staying on top of those programs. It's a partnership with tenants, taking a long view and staying positive here, definitely diving into tenants' business and working with the tenants having a plan, staying nimble, again, talking to landlords and just being open. I want to say on the investor side, probably the volatile asset. So monitoring the evolution of the asset class as it goes through change is going to be key. This asset changes quickly. It's going to change quickly going forward. So staying on top of that landscape is, watching the landscape is important. I'll wrap up with the investment in multifamily markets. So taking a look at trades, This slide shows the trade volume last year, which, you know, quite frankly, was fairly strong, but it was on good quality product. We had a actually above 2018 and 2019 numbers. A few reasons for that. Lending rates have held at historic lows, you know, and however, I mean, actual lending tightened up on limited appetite for risk. So the result of all of that, and we know some of these trades were carry-ins from last year, but the result is of the market reality is tougher deal closing and restrictive movement, but still a respectable just over 111 million overall. By asset class, industrial multifamily properties continue to see the greatest market performance, and that trend is going to continue. I think that follows in line with Scott's comments. When we take a look at multifamily trades on a per unit basis or per door, our price ranges in the past year have been quite extreme, but that's really a byproduct of the quality of product that's on the market. So we see numbers in the mid to low 90s, $90,000 per door, to highs of you know, 190,000 per door, again based on quality. Last year's average was a 104, just over $100,000 per door. So demand remains high, and we don't really see that trend changing whatsoever going forward. When we look at notable transactions, we decided to pull a sprinkling of the province simply because it's a smaller market here, and we know we've got folks from outside listening in. Elk Ridge, this was the province's only 5-star resort and conference center. This one went through a grind to get there, sold to a local group, which are happy to see it getting back on its feet. Wanuskewin deal, that was a sale leaseback involving Norseman Industries, their flagship property, and the city of Saskatoon for $15 million tag. Park Street was a deal that our debt advisory team financed, and shows some of the competitive lending rates that can happen in the market at 2.63 on a 5-year deal, I should say. And Davin Place sold for 141,000 door. The big Cope Crescent down in the bottom left hand, it's just an example of the demand for multifamily with commercial space. So some distribution of income. Just over 30,000 feet of commercial, 112 units sold for 34 million to a BC fund at just over a 5 cap. Last one being Boardwalk Manor, which traded at just over $102,000 per door. So I'm going to stop and catch my breath. Kind of felt like an auctioneer to go through that. Definitely not a tutorial. We're really just doing an information dump here. I want to thank you for your time and attention, and always for your business. Before we wrap up, one thing, what we wanted to do is really get some feedback and input from everyone on the call. And so, and Tom and Scott, I don't know if you want to jump in here, but we're going to go, there's five survey questions that I'd like to bring up on the screen.
Sure.
And these are live. They won't take long to walk through. So how long do you think it will take for the economic recovery to occur in Saskatchewan? Multiple choice. Julie, I don't know how long we've got for people to answer on this, but it won't take long to click one of those boxes. I think there's some pretty strong opinions here. Survey says, there we go. 1 to 2 years. The Pareto law, the old, the 80-20 rule, about 80% in the next 1 to 2 years. Question number 2. What percentage of people will continue to work from home post-pandemic? Great question to guide investors and landlords, all of us in the industry, really.
be nice to do this one over a period of 6-month intervals to see what people's opinion changes as time goes along.
Easily done, right?
Yeah.
When we release some of our reports, we should do another one of these. And a little drum roll, look at that, 25%.
Yeah.
So
Yeah.
a 75% occupancy.
I'm going to guess that I think it's going to be lower, just talking to some of the major users out there. I think it's going to be at the end of this, there's lots of fatigue of people working from home. So I think it's going to be closer to 10%. So
Okay.
maybe your gradients were too big.
Well,
20
we know you cheer for the Leafs, Scott, so we're going to hold you to both of those predictions.
Could you please say the first place Toronto Maple Leafs? It doesn't.
Yeah.
It hasn't been said often in my life.
Yes.
Um,
Overall, where do you see rental rates headed the next year in Saskatchewan? Net rental rates. This is a very general question because we didn't break it out by asset class, but it is a pulse check. And a drum roll. Just under 60% at no change.
Be very specific to specific assets and such circumstances is probably would be my my thought on that one.
Okay. This is taking a look at the future. You know, we're interested in what your 1 to 3 year investment outlook for real estate is in our province. Positive, negative, neutral, or uncertain. Tom, I think that was the 4th question. So the most important one is coming up next, I think.
Right.
So, oh, look at that. Great news.
Neutral. Yeah, it's great to see that the limited number of people who think it's negative. That would that bodes well. Optimism goes well.
Typical Saskatchewan optimism. I
think the last question we should let Scott answer.
Scott, yeah, you'll get a head start on this one. So the most important question was left for last.
Won't be the Argos. Pretty much guarantee you that.
Yeah.
The Leafs have a better chance of winning the Stanley Cup than the Argos winning the Grey Cup. So.
Well, we'll just test we'll see what this one comes out at. This is assuming we've got a season.
Yeah.
It's 5 after 11, so we've run a little bit long. Absolutely. Jeez. No question.
You got to love the answers.
Yes, yes, for sure. I didn't look at the
Yeah. It's 5 after 11, and so I think there was some good questions that came in the chat room, but I'm also cognizant of people's times, and so hopefully we can circle back with the people that asked those questions and give a response to them. And thank you. I can't thank everybody enough for spending the time with us this morning. Again, sorry we don't have a chance to see each other in person or face to face, because that would have been tremendous, but hopefully by next year it'll be safe to do so. And I'd like to thank you, Scott, for taking the time to put together that overview and oversight for us. And like has been said before, everything, one of the benefits in Saskatchewan, besides being flat, is we get to see the future coming our way. And by understanding what's going on in the major markets, I think it helps us understand what people are thinking. National tenants, occupiers, lenders, everybody. It's good to know what's going on because it does impact us. And thank you to Richard for the insights into the Regina market specifically, and to all our team that helped put it together. So, and to everybody on the call, thank you to our clients. Those of you who aren't our clients, we'd love for you to be our clients, and would like to engage with you at any time. So please reach out. Again, thank you very much, and have a great day and a great year ahead.